Our final market snapshot will be industrial. We'll overlook the vacancy data. We'll then go into the current status, the market trends, the future, and again, the tenant perspective.
Okay, so we're seeing consistently over every industrial market that vacancy levels are continuing to decrease to extremely low rates. Sydney at 0.3% has the lowest industrial vacancy rate of any city in the world. This low vacancy, of course, has seen an increase in net face rents across all markets. I'll pass over to Michael now for his advice in this tough market.
Thanks, Gillian, and good morning, everyone. Look, regrettably, it's the status quo for the industrial sector. And despite there's no new data for this quarter, I can say with complete confidence that the trends we've seen over the last 18 months have continued. That is, dwindling vacancy rates, low supply, incentives are virtually evaporating, and increasing rents across all markets in the ANZ region. So that means that the market conditions are the ticker on the barometer is very much in favour of the landlord and it's tenant unfriendly, and as a result they're able to leverage in most cases the lease norms are again on the tenant unfriendly situation. So if we move to the next slide, we'll see what's behind this. So there are a number of factors that have contributed to the current trends. The e-commerce and logistics continue to dominate the market, both through their demand for the large distribution centres, but also for their smaller last mile solutions closer to the CBD markets. The supply of new stock is not meeting the market. Indeed, CBRE, our colleagues at CBRE are describing it as a chronic shortage. This has in turn led to pent-up demand, meaning there are occupiers in the market that are looking but are just not able to find a solution for their accommodation requirements. This is often leading to short-term renewals and which the tenant is very much at the mercy of the landlord. Excuse me. The net effect is that there's continued upward pressure on rents and vacancy levels continue to contract. As Gillian alluded to earlier, Australia's industrial vacancy rates are the lowest in the world. There is some evidence, however, that the market is slowing due to the economic uncertainty, the rising costs, and also the inflationary pressure. However, at this stage, it's only really translating into a lower rate of growth, down from over 10% per annum to single-digit growth. If we go to the next slide. This is a new slide that we've thrown in this quarter. One of the questions I'm most frequently being asked is how sustainable is this growth? And despite us seeing some dampening in growth rates, this is frankly a very, very difficult question to answer. But I think there's probably 5 key factors that will ultimately determine where the market ends up over, say, the next 2, 3, 5 years. And all of these factors are necessarily interdependent. Those being demand, supply, interest rates, the domestic economy, global economy, specifically inflationary pressures, and finally the construction and development costs. First, demand. Demand has slowed, as I mentioned earlier. This is largely on the slowing take-up and penetration of e-commerce, which has plateaued over the last 6 months. But we remain behind the rest of the world with only 14% of retail sales being online. Experts are suggesting that growth will continue, but at a much slower rate, reaching penetration of about 17% by 2026. And despite interest rates being on the rise, which of course hits our back pockets, according to the latest NAB retail report, consumer sentiment and spending remains relatively buoyant. But perhaps there's a lag in those data trends, as I just can't see this continuing to be the case in the current economic environment. However, there is also pent-up demand. As I suggested earlier, and based upon my personal experience, there is just not sufficient stock available, either new or existing, to satisfy that demand. And the final point I'll make on demand is that for the time being, it's relatively inelastic, meaning that the current demand is relatively insensitive to price increases, which of course landlords are relishing. So in summary, demand is likely to moderate, but with pent-up demand, it's likely to continue outstrip supply for the next 2 to 3 years or so. On the supply side, the problem across Australia is there's not enough industrial land being released, and the land that is available is not being developed in a timely fashion. In New South Wales, there's potentially some relief with the finalisation of the Western Sydney Aerotropolis precinct, which has rezoned over 1,000 hectares of industrial land. Also, areas of north of Melbourne, there's some land being released, but in other capitals, there's just really no major releases. As a result of the lack of supply, developers are seriously considering multi-level warehousing, which is a new concept to Australian market, and there are a number of multi-level projects proposed in locations closer to the CBD, where it's anticipated the higher rents that are commanded will offset the higher development costs. Interest rate increases will continue to impact costs to fund development and therefore may stifle supply. It is now being reported that developers are seeking higher, what we call economic rents rather than market-based rents to satisfy their financial hurdles. This will have a pull-along effect and continue to increase rents. With demand, as I said, being relatively inelastic, the big end of town and the big users will absorb those increased costs, but the SME and the smaller firms will continue to be under pressure. Of course, interest rates will also impact our discretionary spend. It's logical to expect that further interest rate increases will impact consumer sentiment and discretionary spend will decrease. And with a good portion of e-commerce spend being on the back of our discretionary spend, it's not unreasonable to conclude that this will impact future warehousing requirements. Probably the most difficult question, however, to answer is how global and domestic economic uncertainty will impact the market and how the government fiscal and monetary policy responds. Worst case scenario, of course, is the domestic economy falls into a recession, which I hasten to add is not likely to be beneficial to either the landlord or the tenant. And economic growth stalls or recedes, inflationary pressures continue, consumer sentiment and spending falters, and demand for industrial space dampens. That said, for the short term, given the pent-up demand and lack of supply, perhaps the market will simply plateau at its current level and the pain for the occupier will continue. Finally, construction costs have risen significantly since the onset of the pandemic. This, coupled with labour shortages and supply chain disruptions, has not only caused total development costs to increase, but has also caused development delays. And as alluded to earlier, in response, landlords are now introducing the concept of economic rents rather than the market-based rents that we've traditionally seen. This is in order to maintain their development margins. But is this sustainable? So in summary, it's my opinion that for the short term, say the next 2 to 3 years, the industrial market will remain the landlord's market. Perhaps not as strong as the past 18 months, but the ticker on the barometer will be in favour of the landlord. If you move on to the next slide. Look, it's a tough market, both in terms of the lease norm and the market conditions being in favour of the landlord. But what can the market do what can a tenant do in the market that we're currently experiencing? As the other guys have said, future-proof your property and implicitly your business by engaging with the market early to ensure that you're well informed and in a position to act promptly. This is really relevant in the industrial market. Gone are the days where you can simply rely upon a real estate search engine to provide you with a range of options. Almost exclusively, industrial transactions are being negotiated off market. And you're finding that you have to have a network of agents, owners, and developers to be able to leverage off to ensure that you're actually in the game. And by going to the market as well early, tenants are in a better position to consider pre-commitment opportunities in which a landlord would develop a bespoke facility based upon your requirements. Other things that we're seeing is that rather than relocating or going to new, expanding their footprint, businesses are now looking at how they may better enable the technology. As a result, they can optimize their footprint by keeping within the same space, but maybe going up or enabling technology and at the same time increasing their productivity. Another way that you could look at things is perhaps look further afield. Of course, that's not going to be relevant to everyone, but there are regional and emerging markets, for example, the Western Sydney Aerotropolis, where there's generally more available stock and there are more affordable rentals. And finally, in a tough market, perhaps focus on the lease terms. At LPC, we focus on five key areas, which is cost, risk, flexibility, obligations, and guarantees. And in the current market, it's probably difficult to counter the arguments for increased or the rentals that we're seeing at the moment and lower incentives. So we're advising clients that it's perhaps more appropriate to focus on their lease terms. That provides more flexibility and places increased obligations on landlords. Of course, the same could apply with your current lease, and perhaps in this current market, it's best to stay put with the devil you do know and look at restructuring your current lease terms and conditions. all in all, it sounds very, very simple, but in practice, it's a really challenging market, and it takes patience and skill to get a favourable outcome. Back to you, Ed.
Thanks, Michael. We've reached the Q&A